Even though we can see tiny indications of the housing market trying to get back to more normal conditions, home prices still hit a record high this week. Buyers are still in a heavy competitive market, and there is far more demand than there is supply to meet it. That seems to be slowly improving, but it's a long way from a normal real estate market. Every week, Altos Research tracks every home for sale in the country. We analyze all the pricing and all the supply and demand and all the changes in that data, and we make it available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the CEO of Altos Research. And let's see the details for the week of May 2, 2022. Median home price hit a new record high this week. If you've been watching these videos each week, you'll know that this is actually not surprising. The median price of single-family homes in the U.S. is now $425,000. We have a few more weeks of prices to rise before hitting the summer plateau. $440,000 would be 10% higher than last year's peak, and somewhere around there, $435,000 or $440,000 before the summer. You can see in the dark red line here, we should expect that price trend to turn flat by mid-June before backing off later in the year. In fact, the price of the new listings hit a new record high this week also $425,000. That's the light red line here. This is the median price of all the homes that got listed this week. When the price of the new listings rises, that's because sellers are leaning into demand. If demand were weakening, which sellers and listing agents would see with fewer bidding wars or lighter foot traffic at open homes, then they'd know to price a little lower. And you can see that the light red line starts to ease down before the dark red line earlier in the year. But that's not happening in any measurable way right now. In a normal year, we're right now around the peak of the price of the new listings, as April and May are really the peak of the buying season. So the other side of the demand indicator, when homes are listed for sale, sometimes they're overpriced and they take a price cut before they sell. There are different reasons for overpricing. Sometimes it's intentional, sometimes accidental. Each line here is a year's curve of price reductions. Normally, 30% or so of homes take a price cut before selling. For the last 2 years, as demand spiked, far fewer sellers needed to cut their price because the buyers were willing to pay. Right now, there are just 19% of homes on the market that have taken a price cut. That's the dark red line here. It's steadily increasing each week. You can see how we're notably deviating from last year's trend at this time. Last year, price reductions didn't start normalizing until June. We're on pace now to have a much more normal housing market in the second half of 2022. The dark blue line here on this chart is 2018. That's the last time mortgage rates rose, and you can see how the price reductions rose at the same time. Sellers who listed their homes, for example, in August of 2018 were kind of surprised that the market had slowed. That's something to keep in mind with sellers right now. The pattern looks likely to repeat. So, yes, we can see price reductions starting to get a little closer to normal. But from our immediate sales tracker, you can see that there's still way more demand than available supply. This week, 28,000 new listings took offers and went into contract essentially immediately. 28% of the market. That's slightly fewer as a percentage than earlier this year. The light red portion of each bar are those that went into contract immediately. And it's starting to compress. Tiny little bits. The pace of these immediate sales seems to be shrinking like just a little bit each week. So, like our price reductions, this shows us that the market is still crazy hot, but maybe letting off a little bit of steam as we return to more normal conditions later in the year. And that brings us to inventory. Available inventory of unsold single-family homes increased by a solid 6% this week to 292,000. It's the spring, and so we had the most new listings all year last week. That's totally normal. This week last year was the low point of inventory for the year, and that was super late in the season. But since we are still fewer homes than we were last year at this time, 307,000 then versus 292 now, and 800,000 or 900,000 in a normal year, or 292 and 800,000 or 900,000 is normal. Each week with rising inventory that's a welcome sight. So at this point in 2019, we were still feeling the after effects of that 2018's rising mortgage rates. And you can see that we had 871,000 single-family homes active, unsold, on the market at the end of April. So given that we had healthy price increases this week, and healthy inventory increases this week, here is the forecast of inventory for the rest of the year. Each line here is a year again. The dotted red line is how we expect inventory to change weekly for the rest of the year. Sometime in the next 4 to 5 weeks, we will likely have our first year-over-year gains in inventory. When projecting what might happen to inventory as the year progresses, we are leaning on 2018. That's when the dark blue line here, when rates rose. And inventory started that year low and ended just a little bit higher. So we have the normal seasonal trends with the added impact of the higher cost of money factoring into the forecast. What's interesting is that most buyers aren't making yes or no decisions based on mortgage rates. Most buyers buy based on life events. I had that second kid and we need another bedroom. Most buyers are making, though, maybe selection choices based on rates. Buy house B instead of house A for affordability. If you're a first-time buyer, you aren't even making that trade-off. For first-time buyers, it's time to buy a house, and this is how the economics work right now, so these are the houses I can buy. So rising rates don't really lead to a cratering of demand or a flood of inventory. Rates don't change those life events. But rising rates do make some deals less palatable. So for instance, in the last decade, as people moved to their next home, the really low rates made it very affordable to just keep the old one too. Now I have an investment property with 2 mortgages. These investment deals are why we have had fewer and fewer homes for sale each year. A lot of people are doubling up. Buy the next home, don't sell the first. But when rates are 5.5%, for example, many of those doubling up investments deals are harder to pull off. So we get a few more listings. And that's what we expect to see later this year. Like 2018, available inventory should start to edge up year over year. But it is important to note that there is no catalyst for like hundreds of thousands of new listings. It's really hard for me to imagine a scenario that gets us back to normal levels of inventory anytime soon. It's likely a multi-year process. Okay, that's all the data we have time for this week. While we are starting to see the market slow in a couple of the early leading indicators, price reductions, for example, it's still really a story of continued buyer demand. We can see changes on the horizon, but if you're buying right now, it's a competitive, crazy market. If you're watching these videos and wondering how you can get the data to your clients right now to help them make these decisions, go to altosresearch.com, get the data, meet with our team. We'll take care of all of that for you. We also have a great new Top of Mind podcast coming out Wednesday. Stay tuned for that one. Going to be a really cool one this week. Our May webinar is next week, Thursday, May 12th. We've already got tons of people registered for this one. We'll spend a lot of time looking at all the leading indicators. How deep and how quickly might this market slow? What does this mean for your buyers and sellers? So there's a link to register for that webinar in the description below. Click that and join us. Like I said, we've already got tons of people registered for that. So that's all for this week. More next week.